It's not too late to go out there and start sharing what you know and building a presence online. I would encourage anybody to do that. It's changed my life. It's brought all of us ahead 20 years in our career.
My name is Nick Huber, and I would like to formally welcome you to the Fort with Chris Powers and my friend Mitchell Baldridge.
Thank you for having me. We were supposed to do this
Nick.
live today, but it is 26 degrees in Fort Worth. It was sleeting for about an hour, and the whole city shut down. So we're now doing this virtually, but it's great to be with you boys today.
My son Timothy is the most disappointed among us.
Yeah, Matthew's bummed out too.
Yeah, they were going to bring their kids. We were going to take all of our kids to the rodeo because that's what we do in Texas.
We're going to Houston now, though.
Mm-hmm.
We'll figure something out.
What do y'all want to start with?
Real estate business sucks. And I'll start with, I want to relay a conversation. I know we want to go into some tax because we have the real estate tax specialist here, but I called you, Chris, 2 months ago, probably, maybe 3 at this point, and said, and I probably spent the first, and we talk every two or 3 months and we'll have a long conversation. I spent the first 10 minutes of this call complaining, griping, deals aren't making sense, real estate sucks, this is hard, my acquisitions guys are going to quit, we're not finding anything worth buying. And you listened and you listened and you listened, and then probably 10 minutes in you said, Nick, do you think anybody's having fun in this business right now? Like, what do you want to do? And I was like, well, should we go pencils down? And I said, and that's what kind of lit Chris up. He's like, pencils down. Like, that's one of my favorite concepts, because the real players in this business, there's no such thing as pencils down. It's not fun for anybody. Nick, suck it up and get to work. If you want to build a real estate private equity company that can survive the ages, that can buy when it gets good and can survive when it gets bad, there's no pencils down. There's no loss of focus. There's no laziness when the business is not fun. He said, Nick, nobody's been having fun the last 6 months. It's hard out there. Suck it up and get it together.
And I meant every word of it. I meant what I said. I think pencils down is, Eric Weatherholt said it, is followers following followers. It sucks. And part of what I want to ask you about is like, what sucks so bad? It's not as fun as it was, but like, if we look back on like prior cycles, like it could be a lot worse right now. Like 08, 09 was like the world was in free fall. And as we sit here today, like I was reading something earlier, everybody's like, if Powell hints that he's going to ease up on interest rate hikes, like we could see the equity market start rushing again. I think the real estate market, that would be the signal for money to start pouring back in. And so the real question goes, all the money in the world can pour in, but the fundamentals of the real estate still working? I don't know about what y'all are seeing. I can tell you from our perspective in our little niche of the world, we're still seeing great fundamentals at the property level. I can't speak for capital markets, but I can for what we can control. But then I think the other thing was, it sucks, like, because there's not a lot of deals trading. But if you're an operator, it's like you were just given another opportunity to go, hey, let's like invert, look inward, let's get operations even tighter. Because all the energy we were spending doing deals, we now get to spend on, becoming more efficient, cutting costs, training people, I know we're going to talk about cost seg, and this isn't, an ad for cost seg, but is going, hey, we're not buying deals this year. What are other ways we can create value? Oh shit, we can go do all these cost segs that we have been like putting off for all this time. So I think some of it's framing it. Again, you can speak maybe a little bit to your markets, but yeah, it's definitely slowed down. I would just say, if you're a true operator, there's something exciting about being given a window in time where you can kind of dial in the operations a little bit tighter and not be distracted by doing tons of deals. So that's why, I said there's always something to be done. And again, if you talk to followers, they're just like, yeah, we're just not going to do much. We're just going to like sit out and blah, blah, blah. Like that just doesn't sound like a winning strategy to me. And that's kind of what I think I conveyed on the phone call that day.
So then, like, what is the path through, in the sense that, does Powell ease up a little bit and then the whole thing booms again and we're back on? Or does this just keep grinding down? Or how long can people just keep saying, we're raising money because we see opportunities out there and we want to be ready to pounce on them? And then when does that play out to where everyone's just finally tapped out, and then people can, and then we can start to build it back up? Or are we even there yet?
That's a good question. Like, I think Nick has a better view of how the normal American consumer is right now, because homes aren't being bought really. People aren't moving right now. Although I would tell you the two realtor buddies of mine in town would say there's been more action in the first 2 weeks of January than there was in like all of Q4 and most of Q3 of last year. I don't know what that signal is. But as far as what you were saying is, all the money in the world can rush in, but if people are busting out of leases and rents have stopped going up, and OpEx continues to go up because of inflation, it can erode at the property level pretty quickly. From our perspective, are rents going up as quickly as they were in 22? No, they're still going up. Vacancy is still very low. Supply is tight. We still having a lot of tours. So I don't know if that answers the question, other than, and I think we can bifurcate the market a bunch on here, is like what asset classes are still working and what are not, and where's the capital going to flow into when it comes back in. But everybody I talk to that's a major capital provider or has raised capital, almost everybody has the same message. Once we see rates stabilize, we're coming back in. We need to see price discovery. And that'll happen when rates, start to normalize. But again, rates could stop where they're at, but that doesn't mean the tenants are going to be profitable and, everything's going to be hunky dory. So that's kind of what I'm watching for. And I don't know about y'all, but 3% GDP increase, 2.9% in Q4. That doesn't feel like this big bad recession that we keep hearing. Nick, you want to add on to that?
Yeah, I think I'll start with the bad. I've looked at my portfolio. I look at it weekly, every single property, who's moving in, who's moving out, at what rents. The bad is that in between November and January 1st, every single one of my 62 properties had a net move out, meaning we lost vacancy. Move-ins, 30% of last year at this time in some of our locations. We have 3 properties of our 62 that are a little bit nerve-wracking, and one of them is literally 53% occupancy, cruising along at like a 2.8% cash-on-cash return. Small deal. Luckily, it's a really small deal. The basis is only $1 million. Our really big deal, the one that, Chris, you mentored me through raising the money on, this big deal in upstate New York, $9 million raise, that deal is doing fine. And we actually executed a refinance a month and a half ago in the middle of this chaos and returned 30% of initial investor capital back. So the big things are going well in our portfolio, but no, there's been many times where I've looked at my portfolio in the last 2 months and been stressed out about one deal, stressed out about a couple properties. And frankly, we have been extremely disciplined in what we've bought, because my CFO is, he balances me out really well, where let's run through a wall, and he's, hey, Nick, this could go really, really wrong if we buy too much crap at the wrong time. So we didn't buy any bad deals, and I feel good, but I know for a fact that in the storage business, there are sponsors out there sending out monthly updates, and they're scared. And if this continues on and the housing market doesn't come back and people don't start in January, you're right. We actually have 8 properties in pretty big positive, meaning like 10 plus net rentals in January. So you're right. Houses all of a sudden started selling. People started renting storage units. But it's nothing like 2020, 2021, even early 2022 as far as the fundamentals of self-storage.
What do you think all these storage renters are doing? Like, what are they just taking their stuff out and throwing it away? Or like what causes this net negative? People don't have the money, the extra income to pay for this stuff? Or like, what's behind these numbers that you can see? I don't know.
Yeah, I don't know. I read a lot from Public Storage, Extra Space Storage, CubeSmart. I read all their earnings calls because I only have 10,000 units, right? Or 12,000 units. And they're all in small, different towns all over the place. What I do know is that we're dropping rents pretty significantly. We are, to get in new tenants. And a huge portion of the self-storage market is transitory tenants, meaning, hey, they are in the middle of a move. They are about to form a household, or they are in the middle of trading, buying houses, remodeling a house, whatever. So if only 20% of the market is literally renting a storage unit for a known period of 3 to 6 months or whatever it might be, and all of a sudden houses stop selling, it makes perfect sense that you're going to see 10 to 15% correction in the market as far as total demand. And when a lot of people bought storage units and there's a lot of new supply coming online, in some major metros still to this day, we're seeing 20% per year of new development coming into a market, meaning if there's 1 million square feet, 200,000 square feet of development in 1 year in some of these major metros. When you have that much supply and you have even a small softening of 10 or 15%, that can take rates 40%, 50% down. And even some of our markets, we're literally dropping rents 30, 40, 50% over what we were charging when we were full. That's significant.
Mitchell, do you have a storage unit?
I was just thinking, I had one storage unit I'm that guy that Nick was talking about. We were moving, we were remodeling. I had one storage unit for 4 months of my life that was full of crap. And then I swept it out and threw the keys back. So, it does make sense that price is found at the edge of the margin, and Nick, you guys were pushing prices so much and life was so good that, if any supply comes online, or if you had cornered all your little markets out there, and if anything comes in, that can kind of change the price by a lot pretty quickly.
Yep. The good news is that sellers have been slowly the last 6 months, they've been coming down in price. We're getting closer and closer and closer to buying more storage. We got a $2 million deal under contract last week. That's great. It's the first deal of the year. It's really the first deal that we've been close on in 3 months.
Why'd you like that deal?
It's just the seller expectations were close. I mean, frankly, a year ago, that's a $3 million deal, and we're buying it this year for $2 million.
I love it that Nick went online and tweeted about his worst deal, the 2%er.
I literally went on and tweeted a little thread. It didn't get very much traction, but our one deal where we bought it and we raised the rents and 40% of our tenants moved out and they're just not moving back in. And it's brutal.
Yeah. So have your opinions changed about vacancy or about it, raising prices? Or you were really, really aggressive about that a year ago.
I think
this changed your whole thesis?
So when we started in the business in 2020, we were underwriting a 15% year one revenue growth. If a property's doing 10 grand a month, we're going to do 11.5, 15% growth. Then all of a sudden we were performing at 25, 30%, even 50% year over year revenue growth. We were buying properties, underwriting 15 and knocking out 40 or 50% revenue growth. And we were making tons of money. Like Bolt Storage, our investors, we made a ton of money in 2021, 2022. Then we started underwriting 20% or so. Okay, if it's going to be 50, we'll underwrite 25. And then boom, now it's back down to 20, 15% revenue growth. And we're underwriting 5 or 10% revenue growth. That's the difference. We could make deals pencil and we could buy more storage if we were willing to underwrite 30% revenue growth like all the other groups are doing. We're not. We're underwriting 15%. And that's why we're just coming up short on most of the offers that we send out there.
Okay, I'll ask a sidebar question here. Most people on Twitter only show their victories. What compels you to show? It's not a loss. It's still making positive cash flow. As someone who understands social media, I would say now as well as anybody out there, what would compel you to want to share that deal with folks? What does that do for you and Bolt Storage as opposed to just not sharing it at all?
I don't know that it does much for Bolt Storage. It definitely makes some investors be like, whoa, I better look a little closer at the updates that Nick is sending. But no, I think we're going to be honest about what's going on. I'm going to tell people when things are not good. And to be honest with you right now, self-storage is not in a good spot. The business is not phenomenal right this moment. But yeah, you share your losses online, and it also makes the people who are in this business understand that there are other people in it with them, and other entrepreneurs who are struggling all the time, just going on Twitter and reading the social media wins from every single person, thinking that it's just so easy to make money. And this world is just, all you got to do is show up and you're going to get rich. That's just not the way it is. It's actually really hard to make money. And I like letting people know that if you want to make some money in this world, you're going to have some losses. Things are going to be hard. You got to share the losses too. I'm a big fan of that.
I can ask you one more question, and then we can move the conversation forward. But back to, you just said something. You said, well, I think in a couple months, or we're almost there. Prices come down. Expectations are coming more in line. In your niche of the woods, is it purely a thing of price? Are you waiting to see renters start renting again? Do you want to see home start selling again? Like, what's your indicator that like we're moving? Or I can offer you an easy out on this. Like we're ours, like if you're always underwriting and if you're always in the game, you're not waiting for like one thing. You're just kind of like, you're so in it. You just kind of intuitively know like it's time to move.
Yeah, that's a really good question. We got aggressive recently on a deal in Northwest Ohio. We got aggressive. It was a market that we liked. We offered probably 30% more than we would offer on the same deal in the South or in other areas of the Northeast. We're ready and willing to buy storage. Our investors are emailing and texting and calling and saying, Nick, I want more storage exposure. I want to go buy storage. I want to buy storage. My team wants to buy storage. Everybody at our company wants to buy storage. And I think it's just a matter of customer prices. I really do. Or sellers. If the sellers come down a little bit more, we're going to start buying a lot of storage, and all of a sudden a $9 million deal, $10 million deal, $15 million deal, those things can stack up. And I wouldn't be surprised at all if we buy $50 to $75 million worth of storage this year, compared to we bought $50 million in 2021. 2022 was much slower, $33 million in acquisitions. In 2022, if it keeps up, will be a little worse, but I wouldn't be surprised if we got back on track.
Chris, how does this stack up to what you and Jason are up to and what Ford's up to? Or how does it, I think it goes from much more retail, somewhat sub-institutional, to what you're doing, which are these, institutional credit tenant kind of bigger deals, and in a different industry. Like, what does it look like to you? And in Texas, for that matter, or, the Sun Belt.
Yeah, Baker, if you're listening to this,
we got to talk about that, by the way.
We're going to talk about that. I think it's been hilarious. He's so funny. He is. I'm just laughing, just thinking of the last 10 things he's tweeted. I would say that Texas continues to remain a really healthy market. There's just no ifs, ands, or about it. I would say that there still is a lot of action at the leasing at level. Now, we own stuff in Memphis. Like, I would say the Memphis stuff doesn't move as fast as Texas or Florida. But I can say that just from like a market perspective, the markets are really moving. A lot of the tenants that we have also are in the construction. They're construction services, construction material providers. I've talked a lot about the tenants that help these cities grow. Well, a lot of the contractors have a huge backlog of business that they're working through. But if you talk to most home builders, like, they truly are pencils down on new deals right now. They're just building out their inventory. So one thing I think about is, okay, what happens if we build out all our inventory and the home builders have not kind of started again? Like, that's a lagging effect. But again, what I would say is, like, there's so many people, like, this is the worst time to not be building housing. It's already really expensive. It's already, the costs are going up, and we're already way behind because 08, 09, 10, and 11, we hardly built anything. So we have a huge supply glut that this is just going to add to. So that's a whole nother conversation, but it's like, man, I hope this doesn't stay down for a long time. But here's the thing, despite everything I just said about great ground game fundamentals, when we were taking portfolios out to market to sell them in like early 2022, 2021, I mean, y'all remember when we were sitting at a bar at Capital Camp and like the world was flying, we were doing big deals. It's dead. Like, it's dead. There's just not, which on one end, on our end, we're like, okay, I guess that's good, but it's surprisingly but it's almost that way across the board. It's not like there's other asset classes where there's a lot of movement right now. But I will tell you again, like I started, I think Wednesday could be really interesting. By the time this comes out, we'll already know what Powell said, but I think Wednesday will be very interesting for the market if he hints that like interest rates are not about to keep going up at the rates that they've been going up. But I'll take a step back also from that. I don't know if y'all have traveled lately, like if y'all are going to restaurants, but like everywhere I go, like there's no hint of a recession like anywhere. We were in Miami this past weekend for a YPO deal. I mean, dude, money is pouring out of people's pockets. Now, again, there would be some people that would say, yeah, that we're getting close to the end of consumer savings, like finally having depleted. I don't even know if I'm answering your question. It's like I just look at the world in two ways right now. It's like capital markets and then ground game. And for our neck of the woods, people are still leasing. One thing Nick said is he talked about new supply of storage units. There is no new supply of Class B industrial. There is none. It's actually depleting.
That would be so nice. Gosh, I'm jealous.
That's not what Baker said.
And the crazy thing is like,
back to that.
And maybe Nick, you can answer. Yeah, maybe you can answer this, Nick. But like, there's a very big divide of Class B versus Class A and industrial. Like, it's unequivocally two different uses, two different types of tenants. You would never look at a Class B and be like, well, we couldn't find what we like. Let's just go get something Class A. But when you think about storage, like I get there's differences, there's air controlled, there's nuances in how the buildings are built.
I think I know why. So self-storage, you can build an 80,000 square foot rentable storage facility on 3 acres. That means layer, like you're going to build it up in levels. And when you build it, the day you build it, the day you get your certificate of occupancy, it's worth $50 to $100 more per square foot than you paid to build it. If you fill it up, it's worth $300 or $400 a foot. So Chris, you're doing big deals and massive dollar figures, but still your average purchase price is right around replacement cost, right? So it still does not make sense. So a developer looks at self-storage and they say, oh, I can go buy a piece of property for $3 or $4 million. I can spend $10 million building a 100,000 square foot facility or 70,000 square foot facility, and then I can sell it for 20 million.
Or at least
I'm going to make $7 million. Like or lease it up and sell it for 30. So I'm going to make $7 million or $17 million. So I'm going to do that all day. I'm going to go to every single property. I'm going to build them. I'm going to sell them. I'm going to make tons of money. The buildings you're buying, Chris, they take 6, 7, 8 acres. They're trading under $200 a foot. You can't build them and make a profit.
One of the other questions I had was, do any of your tenants, are they out in the market going, I'll look at one of Nick's properties. I'll look at the brand new thing that, the public REIT just built. Like, is there that much difference in, like, would a tenant that's looking at a Class B self-storage property also maybe go shop a Class A property? Or would a Class A customer go, you know what? I didn't like this. There's a nicer Class B closer to my house. I'm just going to take that one instead. Like, I guess my question is, do the customers kind of float between the classes? Because like what I'm doing is there's no new supply, but tenants are also not floating. Like they have my product and that is it.
Mm-hmm. Yeah, our tenants absolutely float. If anything, Class B and C are preferable because you don't have to get in an elevator with your stuff to go up to the 3rd floor.
Oh,
I mean, they build Class A. They build Class A storage for one reason, and that's because there's no other class of storage that they could build on this 3 acres to get 70,000 rentable square feet of storage. They have to go up, they have to build it inside, and they have to have elevators. They've branded them as, oh, I'm going to rent the nice storage facility, when really it's a giant pain in your butt because you got to pull up a truck, get out of the truck, put it on a dolly, put it in the elevator, go up the elevator, go down the hall, turn left, and find your unit. Whereas my storage unit, they can pull right up to it. So yeah, we're shopping for the same customers, and Class A is kind of a scam in our business, except for Class A means it's in a really good market where the land value is good and there's houses everywhere, and they couldn't afford to build a property on 5, 6, 7 acres.
I think also Nick's customers repricing every 3 months or 1 month for that matter. Your customers repricing every 5 years. It's also a matter of, just how quick is the customer pool turning over? How quick is the rent roll turning over? How fixed is the debt, and how locked in are you to what your property was worth 18 months ago? And how quickly can you change your psychology to be able to accept less with rising rates? That's what's going to ultimately open up capital markets. Or when does the debt start turning over? And when
I can see
just
an upturn, a really good market can affect us really well. Like we can raise rents 25%, 40% year over year at a storage facility because we have 1 month leases and we can just keep raising rents. It can also affect us similarly on the other side. As rates drop, we're moving out tenants. We're moving out 3 or 4% of our tenants every single month. We're moving in 3 or 4 tenants at a lower rate. Same thing can happen. So I feel like industrial is just more even because you got 1 year leases.
Yeah, no, that's fair. I think that our big thing that we're thinking about is just you kind of asked like, what's the big thing right now is like, yes, deals. And, as our asset class kind of institutionalizes, there's a lot like the deals we're starting to look at are $100 million, $200 million, $300 million, large aggregated portfolios. So we have kind of two ends of our business. We're still aggregating and looking to sell up chain, and we're also kind of up chain trying to buy from aggregators. And so
a big to get there. How do you do that, Chris? Because like my model, syndicating small $2 to $10 million deals in self-storage is nothing like the big deals. It's nothing like doing the big ones. So are you feel like you're in two different businesses doing the roll up and the roller upper?
Well, the roll-up still, like in perspective, like a roll-up for us would still be like a $300 million roll-up, but we would also buy a $300 million roll-up from somebody else, if that makes sense. So it's weird. It's like we've reached a scale and a size where we can kind of play both. Our minimum deal size now that makes most sense is about 15 million. We'll go down if it's accretive or it's like adjacent or it adds some value to something we already own. But that's created another set of things to think about, which for us, and we've talked about this, I think all of us on here have talked about it at some point offline, is how's our equity going to keep coming in? We raised over 200 million of equity last year, like perpetually raising money constantly nonstop.
From smaller $50, $100, $250,000 checks.
It's a lot. And so what we're saying is like, look, maybe we just raise one vehicle. We'll still go raise from all of our current investors that have been so great and loyal to us, but maybe it's time to think about raising more from bigger players, having it once, and then really being able to go out into the market with loaded capital ready to go. We might not have the best terms that we would have on any one individual deal, but if you start looking at like maybe a smaller piece of a bigger pie is the way to really take the company to the next level, that's like our next big challenge. And again, I think everybody on our team would say right now we've had a slower 9 months. I mean, the things we're working on internally, we just wouldn't have had time for if we were constantly processing deals like we have been the last couple of years. And so whether it's capital raising, fine tuning a few things that we want to get better at internally, that's kind of where our head's at, because we think that once the markets open back up, there's going to be a lot of opportunity and a lot of people. You think of all these people that wanted to sell. I always think about this. There's all these sellers that like missed the boat, but mentally like they're there. There's going to be a flood of sellers coming to market that have tried holding off as long as possible, especially if they're staring at a new loan that they're going to have to come get. So I think as much as buyers are getting hungry, there's a lot of sellers getting antsy too that have probably conditioned themselves to go, yeah, we're not getting what we got in 22. Like that ship has sailed. And
I want interest rates to stay high. I want them to stay here for 2, 3, 5 years. It would be hard. It would be hard for me. It would be hard for you. We would not have the liquidity events. We wouldn't have the refis. I wouldn't be able to do something with one property and put $3-5 million in my checking account. But it would get hard, and it would be a lot harder for the people that don't have their shit together. They're not charging the right management fees, and it would soften the market, and we'd be able to buy a lot of storage on the other side.
Agreed. It makes business harder, and that's good for good operators.
Because it's just notes are going to come due, and people who had 3.75 lock in for 5 years, when that comes up and it's 8%, yeah, and you held off and you held off and you held off, what are you going to do? Are you going to go pay?
We're looking at deals. They're small. They're $2, $3, $4 million deals. We're looking at these deals from people who had no idea what they were doing, buying a storage facility. They bought it for too much money. They have too much debt on it, and we're not willing to pay them what they paid. They're willing to sell it to us what they paid, and we're like, that's not a good deal. Sorry, buddy. And they're getting bailed out. They're selling them to other people right now. I don't know how long they'll be able to do that if interest rates staying at 6.5%. I mean, the borrowing rate right now for a small time storage unit is 6.5%. You can't buy 5 caps.
Sam Zell said something at a talk in Chicago in October of last year, which I thought made a lot of sense. And I promise we won't go down the woke path because we all know that that's just a stupid way to live. But he basically said that when you have zero interest rates, people get really lazy because the cost to punt a project an extra month or not do anything, or your property sits vacant another month, like it costs you nothing to delay and wait. As interest rates rise, like there's actually a clock that's ticking again. People have to move quicker. People have to start doing things. People have to create momentum, create tenants, which is ultimately going to be healthy. Like as unhealthy as it's going to be for the fakers or the people that probably thought they were operators that they're not, it is going to reignite people's passion to get work done, which in and of itself is like good for the industry as a whole, because there's been no cost to pay for like laziness. And that has no place in the business world. The lazy companies should not be allowed to exist for a long time.
I'm going to expand exactly on what you said, Chris. I think there's 2 camps. There's the people without capital, the scrappy people, the people like me who are raising capital to go add value to the world. It gets hard for us because the people with the capital, the people who already have it, the cash, they don't need me anymore. They can buy treasuries for 4 or 5%. So the people with the cash get lazy. They get to just put their money to work and relax. And the people like me who are living on the edge of saying, okay, you're going to let me borrow money for 3%, but I'm going to add 5% of value and I'm going to live in that margin. That's where I'm going to live. That's where I'm going to make my money. That gets a lot harder when it's 6.5%. You got to add 8.5 or 9% of value to have your margin there. So it makes us, the scrap people, the people who are trying to make their money on sweat equity, makes us have to work harder, and it makes the people with the cash, they get to just call the shots, and the leverage is shifted. It's so funny, Chris, that we were on this show 2 years ago saying the risk-free return for capital is 0. Our energy as syndicators, as real estate investors, we are in so high demand because we can create yield and nobody else can. That's literally what we were saying. And now the tide has shifted where the Fed has created yield and they don't need us anymore.
So, Nick, you were just describing the economics of a money printing machine of going and building storage for, $120 a foot and then turning it into $300 a foot leased up. Do you just go out on the risk curve and start doing development deals that you said, 18 months ago were irresponsible and stupid? Or is that even more stupid today?
I think developers are living in that margin more than anybody, right? They're able to sell it for $20 million because the capital is willing to buy it for a 3.5% cap rate. If the capital all of a sudden says, I'm going to give you a 5% cap rate, that's their margin and it's gone and the development no longer makes sense. And if development costs don't go down and it continues to cost, $200 a foot to build quality buildings in America, all of a sudden it's pencils down for all the developers because there's no margin for them. What they do does not add value to the capital that would invest in them.
But then when you can buy storage at replacement costs, Chris can go buy Class B industrial well below replacement costs. Hopefully,
yeah.
Hopefully for you, Chris.
We'll
and
see.
Literally, and I think this is the biggest thing. And we were talking about floating tenants that could float in and out of Class A, Class B. There is no new supply. In fact, they're depleting. Come to Dallas. I'll go take you to the coolest neighborhoods in Dallas. It's all old industrial parks. Now, you could go out to the fringes of the city and build, 20,000 feet, 100,000 feet of contractor garages. But like net, it's not going to put any dent in our world. And so I will get on this podcast the day I go, man, I'm really freaking worried over the long term. I don't know what's going to happen in the next year, is when I go, man, somebody figured out how to start building this stuff. But the good thing also about our asset class that self-storage doesn't have, I'm not comparing one or the other. You can't go vertical with what we have. You can't pull an 18-wheeler into a 3rd-story building, unload your stuff. So we can only deal in one story, which I don't think I've talked about a whole lot. So I don't have to worry about, can my guys now, put it on 3 acres and go 10 stories tall. It just doesn't work. So
yeah, they say God doesn't make any more real estate, but the real estate developers literally triple and quadruple the amount of square footage on a site by going boom, 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 up in the air.
That's
And
very
that's a huge
true.
deal. Absolutely.
Let's talk cost segs, because if we're sitting here at a time when people aren't buying a lot of deals and they're looking at their portfolios and they're like, shit, we got to do something good. One thing that I think y'all have certainly made sexy, but I think, the truth is I was in real estate for 12 years before I even heard of a cost seg. I think there's still a lot of folks. I mean, maybe I was late to the game, but as people are sitting here going into 2023, I think my first question is, if it's already 2023, is it too late to do a cost seg that would retroactively go into 2022? And now they're only playing the game for this year?
So in September of 2017, the Tax Cuts Jobs Act was passed. And so that was the last time that cost seg really broke open, because what they allowed us to do was bonus depreciate used property. And so that kind of changed the game. So anything that people have bought after September of 2017 can still be cost seg, and you can file this form 3115 to kind of like change the way that you depreciate that asset, or kind of redefine how you're going to account for this asset depreciation. So people are still sitting on, the best way to look at a cost seg is it's a deferred tax liability. So you go take a deduction today that you were entitled to many years from now. So you're effectively creating a liability to the IRS, but it's an interest-free loan that you get to borrow from the IRS. So anyone who has properties they bought in the past 4 years can go out there and cost segregate and take a load of bonus depreciation that's sitting out there and go effectively borrow money from the IRS. It works if you're going to hold the property, for a few years. But
why?
There's something out there called recapture, and recapture's real. There's ways you can mitigate around it. But if you're just going to take a bunch of depreciation today only to go pay it back 2 years from now, you may not be serving you and your investors in the best way, as opposed to, there's a strategy to say, hey, I want the deduction today because I had a big income event, and I'll take the recapture when the cash comes back. But really, out there today, like you mentioned, Chris, there's just very little kind of market penetration of this idea. That's why we're really bullish about it. It's because it helps people. Yeah.
It's a battle with CPAs. Literally, we have clients all the time say, my CPA said that this is probably not a good idea because of recapture. And what that means is you buy a property, you're going to depreciate a big chunk, take a big tax write-off. And if you sell it later, that's now income. That's now a gain that you have to make up for. That's recapture. But you're literally saving taxes today and paying them 3, 4, 5 years from now. It's a no-brainer.
Or you're 1031ing and rolling into the next deal, or you're dying and stepping up your basis. Hopefully not.
If you bonus depreciate, you hold the properties forever, and then you die. I think this is an important thing for people. What happens when you die?
Well, you go to heaven, hopefully. But beyond that, what happens still on the earth is that, your estate goes through probate and you pay something called an estate tax. So there's two types of estate tax. There's a tax on the income that your estate generates through interest, dividends, and, unearned portfolio income. Set that aside. You just pay that every year the same way you paid it when you were alive. But there's a estate tax, they call it a death tax, on everyone's estate when they die. Well, 99.9% of people pay no estate tax because the kind of exclusion out there is $13 million today. So most people don't have $13 million when they die. Or for a married couple, it's $26 million. But what happens is the value of your assets pass through your estate and they get revalued to the date of death or 6 months after the date of death and are passed on to your heirs. And your heirs get a step up in basis. And then they get to go cost segregate and bonus your land again. So, yeah.
Or they could sell it at the market
thing.
value and pay no income, no capital gains tax.
Yep. And so one other opportunity that Barrett Lindbergh talks about all the time as well is opportunity zones. When you get out of the other side of opportunity zones after 10 years, you get that step up in basis. Again, it's pretty much the only way to do it while living. So the opportunity zone is a good chance out there to defer the tax gain, deduct the hell out of whatever you buy, and then hang on for the 10-year ride, and then go through the other side without having to pay tax when you go sell it. So,
can I tell the story of how RE cost seg came about?
Yeah, tell a story.
Okay, so cost segregations, I've done them for 5 years, and it was fill out a form on somebody's website. Somebody flies to my property 6 weeks, 3 months later. They walk around my property, take a bunch of pictures. Then they go back and they give the pictures to their engineer. They do the engineering and they give me my report 6 to 8 weeks after I order the cost seg. And I have to spend a flight, hotel, travel, $3,000 to $5,000 for a cost seg on $1 million property. Mitchell Baldridge, the smartest guy that I know, had done a ton of cost segs. We got some other engineers hired, started RE cost seg under Mitchell's Baldridge CPA brand. And our idea was virtual site visits, meaning, hey, what if instead of flying somebody out to a property, the day after they sign up for a cost seg, we can get on a Google Meet, Zoom, FaceTime with a customer, walk around the property, take a bunch of screenshots. The very next day, build the model of the house in CAD and get engineers to then run the cost seg studies and do the full-on report and turn it around in 3 to 6 weeks and at 30% less money.
And that's what's happening?
We started the company 7 months ago. Mitchell's wife, Mel, is the CEO. I'm simply a Twitter advisor investor. And Mitchell is the brains behind the cost segs themselves. We now have 14 engineers. We've done 280 cost segs. We booked $250,000 worth of cost seg work in January so far. It's January 30th right now. And the business is frankly put, it's exploding.
Why do you think that is? Because more people are starting to understand that this is working, because a lot of people have properties that they've never done one on, and now they're getting caught up because y'all are great marketers and you're getting in front of people. Like, why is it taking off now, maybe like it hasn't in the past?
I think all of the above. I think the idea that we don't have to fly out and view a property lowers the floor. So we're able to capture a bunch of the market where we have a pretty good edge in, where, you know, they would have called one of these other firms and said, hey, I have this single family rental out in, you know, Little Rock, Arkansas. Yeah, paid $200,000 for it. And everyone would have said, you know what, we don't do this for less than $5,000. And so it's just not worth it because you're not going to get a payback. And we're able to come in and service those folks. I think educating the market, I mean, I'd have to believe that the education that we've done on Twitter has even helped other cost seg companies, and that it's just now everyone's almost like, hey, quit talking about this. We've already heard about it. And there was literally someone on your thread that said, don't talk about cost seg. So
this is for you. Was that Pokemon
this
Troll Boy 69?
Yes, Pokemon Troll Boy got us.
I'm going to keep screaming it from the mountains because people have to hear this. There are real estate investors listening to this that buy $1 million buildings that do not know that they can get a $150,000 deduction that year from depreciation. They don't know it. Their accountants, their CPAs have not paid attention since 2017. They don't know it. They don't want to do the work. It's more work for them. I've had 3 CPAs in my life. Mitchell is my 3rd CPA. I fired the first 2 because they acted like they worked for the IRS. It was their job to make sure that there was no chance I ever didn't pay $1 of taxes that the IRS thought they might have at some point been owed. Whereas now it's like, hey, Nick, these are the things that we can do. This is the case that we can build. All of this is perfectly legal in the tax code. And it's my job as your CPA to make sure that you do that. Unfortunately, most CPAs don't operate that way. And if they got to do more work, if they got to fill out a couple extra boxes on a tax return, or Frank, some of them, if they see their real estate investors make a ton of money and not pay taxes, I don't know. I can't explain it, but many CPAs do not recommend.
It's not fair, Nick. Come on.
We just moved our entire company to Mitchell, but this isn't an advertisement for Baldridge Financial. Okay, my next question. What properties do the best in a cost seg? Because Mitchell, we've talked about this. I'm like, why do you get Nick so much more for self-storage than we can get for industrial? What are things about self-storage? Everybody always says multi does the best in this stuff. Industrial's okay. It's not the best of all of them. But why would one property get more depreciation than the other?
Look at like a single tenant industrial, just big empty box. That is all 39-year, 40-year depreciable life. And where this really benefits is in the 5, 7, 15-year property of the site improvements, or the, like, self-storage has one attribute that really helps it, which are these interior movable walls. The idea that it's all built out of, like, what one of these that Nick had was cinder blocks. Like, the whole thing was built out of cinder blocks, and we couldn't get them crap. You know, it was like, man, we had to give them a discount because we didn't even hit back, what we promised. It's like, I'm paying you more than you got us. But so yeah, this erector set, these movable walls are all depreciable and are expensive and are corrugated metal and take a big kind of percentage value of the property. Like, one asset class is gas stations, are just all 5-year. So go look at Buc-ee's in Texas, that whole Walmart that they have attached to all of those gas pumps. If the gas pump, sales are more than the beef jerky sales, they get to classify that whole thing as a gas station and write off those gas stations year one. So that scales obviously down to, the Texaco on the corner with the bulletproof glass out front.
Yeah. But then there's also some advantages of industrial, like huge parking lots, Mitchell, that are all,
sure,
is that 5-year or 10-year parking lot? And then there's underground water retention. Underground water retention is another big one.
If you go back to Buc-ee's, though, for a second, is it because Buc-ee's owns the operating company within the real estate? Like, if we took some of Eric Weatherholt's properties, he owns these amazing restaurants and retail concepts. Does he get to benefit from the same thing that Buc-ee's does, or no?
Well, the same way that if you're doing a bunch of qualified improvements for a tenant build out, you get to go back and deduct that 100%. So TI can really help. And there's something to structuring it the right way on the outset by saying, hey, tenant, you're not going to go buy your TI and depreciate it all. We're going to actually buy and own your oven and just bake it into your lease cost, or make you actually pay out front for some of that out there. So it really, especially when you get into bigger deals, it's worth talking to a CPA and calling us and getting it structured up the right way.
So materials or buildings that have more, that's why industrial doesn't do as well. That's why cinder blocks don't do as well. What about hotels? Like, you have a hotel that's got a big bar, it's got restaurants in it, it's got spas, it's got all the, do hotels do better?
Well, like you said, multifamily, you have an oven, a fridge, a microwave, kind of fancy fixtures and
huge MEPs, the mechanical, electrical, HVAC. Those are huge contracts to build a multi. All that stuff is good for depreciation. The more complex the building.
Yeah, or even if you have special air handling. I mean, like an R&D facility could be nuts. It's just, we took this 39-year Class B industrial, we ripped the whole thing out and we put in, pharma grade, special coolers, special air handlers, all this equipment. Like, that is all bonusable, where Yeah, I mean, a hotel's great. There's a TV in every room. There's, fridges and little things here and there. There's a cooling tower. There are all these kind of pieces that you can start to pull apart. But the real stuff becomes specialty manufacturing and kind of really odds and ends stuff that gets pretty complex, that has big dollars in it, where you can start to pull that apart from just the poured foundation and the exterior walls and the roof, and start to really kind of pull out some value there. Also, the stuff that does worse is when, Nick's stuff does well, because compared to an inner Dallas Class B industrial is on a pretty nice big piece of land that's pretty expensive, versus self-storage that's out on 40 grand of 8 acres. There's very little land value.
Yeah, the land
and you
itself
can't
is not
depreciate land.
Yeah.
Yep.
Are there any other businesses out there that y'all have thought about that could be automated to what y'all did with RE Cost Seg, where there's just too much manual labor? Mitchell's over there just grinning ear to ear right now as I say this. But what else
Nick's
in real
smiling
estate?
too now.
What else could be done? What are the other good ideas out there? Let's talk about like your favorite one.
It's the anti-sweaty startup list.
No, I think tax credits, employee retention credits, R&D credits. I love property tax consulting as a business. I'm sure I'll be involved in that one. Property insurance and casualty. Me and my business partner Dan are making a serious run at acquiring a property insurance company. I love, a lot of small businesses. Front end web dev. A lot of businesses really need help there. But
do those eliminate what are traditionally the sweaty part of a business? And there's things you can do to just make it more efficient. Like I think what y'all did with RE Cost Seg's brilliant. Get the owner to go around on their iPhone, and you've eliminated half the costs that way.
So many of these businesses, Chris, are absolutely horrible at doing what they do. I'll give you an example. We used USI as an insurance broker, one of the biggest in the country. They're top 5 insurance broker in the country for property and casualty. My business partner, Dan, had to go into the business at this company. He went inside of the business and built a system for them to provide us quotes from carriers quicker. It was just an Excel sheet, but they had no method to stay organized with their logins, with what they were doing, with how they were getting bids. The insurance agent was just playing golf all day. Literally, that's what insurance agents do. Producers that succeed, that get their book and they're making $300,000 a year, they play golf all day and ignore your phone calls. That's what they do. So literally, the most stressful part of closing was getting and binding the property insurance certificate, and it was ridiculous. So there's maybe not cheat codes like literally, hey, we don't have to go to this property, we can FaceTime you, but it's just the way these businesses are done and the way these people operate. There's just so much meat on the bone.
Melanie is a big secret weapon in this and that, and Dan Hagberg.
Shout out to Dan, shout out to Melanie, making y'all look good.
But Melanie built this whole, through no code tools, portal system in my CPA firm. And Melanie and I were working together for a year before she kind of spun out and started working on Cost Seg. And we were able to just pick that up and kind of drop it into Cost Seg and just have a system of how we collect information, and have Slack as a tool, and have Google Drive as a tool, and use Google Sheets, and not have Excel version 37, and just a lot of getting rid of friction is just having standard operating procedures. And you just go into every business and there's just tons of friction of just, what's my password?
I'm not asking you to give up your secret sauce, but if on kind of layer deeper on the no code stuff, can you give an example of like one cool process that y'all have created through no code and through
I can
automating
give
stuff?
An example. Like when you go to RE Cost Seg, when you fill out a form for a Cost Seg study, if you put your name and email in and hit next, like we have your information, we can send you 4 automated emails over the next 3 weeks that say, hey, just a reminder, this is how Cost Segs work. This is how we can save you money. Then when you actually fill out the form, automatically, you go into Airtable, the CRM, automatically our sales folks reach out and give you a perfect way to upload exactly what we need, the contract, whatever else we need to do the cost seg. And it's all there for engineers to start doing the work right there. Like literally with some clients, it's a half an hour after the first time they touch us is we have what we need to do the cost seg study. That's just all it is the tools that Mel and the team have built to get information quicker. And it's really fun.
And so we'll go back in and make that even better. And then, we'll be able to, even though the website we were talking about this weekend of just like, we've built a pretty good website. We can pick that up and drop it into something else. Once you get these processes going, it's just tweaking the processes for the next business. And it's really just an information mismatch of, Nick, you're trying to get a property insurance quote, and it's just trying to go to your broker and say, this is where the property is. This is what I'm paying for it. This is the square footage. This is the county. Here you go. You go run your property. You go run your process and feed back the information to me in the format I want. And let's move down the road. So,
okay, guys, I want a piece of property tax appeal business. I know y'all are doing something behind the scenes. I know there's a business plan, but I'll bring my portfolio over. But I want a piece. I want a piece of the appeals business. That's a good business. That's a money making business.
Yeah, I'm still looking for an attorney to partner with there.
It all kind of works together pretty nicely. Of if you can get these tax credits, tax depreciation, tax deduction, and fit it all together, you're really offering, like you said, business owners during a time when everyone's looking for a couple of bucks here or there. Let's find a bunch of either free money that was owed to you that you didn't know, or a tax deferral mechanism, or a savings out there. So,
and the tax credit is going to be open in a week, and that's called taxcredithunter.com for those interested in that. So we have recostseg.com, taxcredithunter.com, a lot of same employees. Mitchell brainchild with his wife Mel.
What's it called? Tax Credit Hunter?
That's it.
You motherfuckers.
So people on Twitter are going to be hearing a lot about tax credits pretty soon.
Is there going to be tax credit hunter guy on Twitter?
Yeah. the
Actually,
tax credit lady.
Mel's running it, so we'll have a tax credit lady because Mel will be the one running that one.
Yeah, I love it.
She's still working out the license for her likeness on that.
I think this is a perfect way to bring home this conversation. We've got another 20 something minutes, but we've been on here plenty of times. I think we've all now been on Twitter for about 3 or 4 years. And we just had conversation about like businesses that y'all are standing up, like almost, I'm not saying overnight, and it doesn't come with a lot of hard work. And you guys have earned the clout. You have great businesses to do this stuff. But I would say without Twitter, without a social presence, without the distribution, this would not have happened the way it happened. So let's just have a conversation on like, what has Twitter meant to you? I was at a conference in Miami over the weekend for 4 days, and I sit down at this table with this total stranger, and he's like, I know who you are from Twitter. And we just go into this whole conversation. Why do you do it? What's it all about? You just get on social media all day. So let's just kind of go unfiltered as like, what does it mean to you? And as you look 10 years out for people that are going, well, if I'm not on yet, it's already too late. Like, where are we going to be 10 years ago? Where are we going to be 10 years from now if we keep all this up? The three of us, there's more that we know of. There's lots of people doing great things on the internet, but like, what does it mean for y'all?
I'll give you 2 examples from me personally. If it wasn't for Twitter and I didn't have a Twitter account and I wouldn't have met Chris Powers, I'd probably have 7 or 8 self-storage properties right now, and I'd be running a moving company. And that's what I'd be doing. Instead, I have raised $40 million. We've bought almost $100 million worth of storage. And now we have some really exciting opportunities in entrepreneurship. But the first deal, Chris, I mean, I was listening to the Fort podcast. This podcast, I was listening to this, and I met Chris on Twitter, and we finally started talking, and he saw something in me that made him think, hey, I'm going to reach out to Nick and help him. I was likable enough to Chris to make him want to mentor me because he was 5 to 10 years ahead of me in my real estate journey. And the way that you helped me build my real estate private equity company from the very beginning, from a fee structure to how we thought about the business, to how we modeled our value add, to how we went out and pitched it to investors, it was shaped by Chris Powers and, Moses Kagan and Mitchell Baldridge. I mean, all the people that I met on Twitter. And now what it's going to do.
But people would say to you, like, how do you really know these people? They're all on Twitter. Like, what do you tell those people? Like, you don't know Mitchell. He lives in Houston. Like, how do you even know this guy?
I looked into my email and saw 7/1/2019. I sent Nick Huber an email. He was on Reddit at the time and just was writing sweaty startup stuff. And I was like, man, what you're writing is super interesting. And then September, he sends me back an email and says, sorry for the delay. Let's talk. And so, but yeah, I mean, I've sent out, I think as you consume all this content and as you start to get into people's heads and listen to 100 Ford episodes and 100, sweaty startup podcast episodes and really see how people tick, you start to say, hey, this is what you do that I identify with. This is what I do that I can help you with. This is what you do that I think you can uniquely help me with. And you start to really build. Yeah, I told Nick, I said, hey, I want to get on a call with you. What do I need to pay you to do that? I was like Nick's first dollar he ever made online because
I charged Mitchell Baldridge $125 for a 1-hour consulting call.
And that was it. So if you just pay Nick $125, he'll
now
give you as much time
when you pay Nick $125 for a consulting, you actually end up talking to someone for $5 in the Philippines. It sounds like Nick.
One of his friends, yeah.
So I think this all boils down to when you're interacting with somebody, when you're at the country club, when you're at the golf course, when you're walking around town, you see how they look and you get a little bit of a chance to talk to them. When you follow somebody on Twitter, you get a look into their brain. Period. Like, Chris, when I follow you on Twitter, I see how you think. When I listen to your podcast, I see how you think. When you started reading my tweets, you start seeing how Nick Huber thinks. So now we have 30 million people a month who read my tweets and see my impressions. And 30 million people a month get to see how Nick Huber thinks. And they get to see what I'm up to and what kind of businesses we're doing. And not only do I get to sell things to those people, but I also get to make a lot of really great connections with friends and add value to people's lives. And they add a ton of value to my life and they make me smarter and better. And, the two people on this call, I mean, nobody's influenced me more than you two. So
same thing. I mean, the three of us have had I say it again. It's like, I'm not saying it as a promo. It's like, to move our company to Mitchell's company to do all of our it's just a big decision. We're at a size now to move that level of work with anybody, to change insurance agents, it's just an unbelievable commitment. It takes a lot of work. It takes a lot of planning. It takes a lot of trust. But to sit here and go like, yeah, I would not have, it all happened from Twitter. I've sat on 2 company boards from people I met on Twitter. I don't know how much money we've raised because of Twitter and the podcast, but it's a lot. We've done deals. We've recruited. And I think it's funny because like I still talk to people and it's like they cannot comprehend how that would happen. I actually gave a talk at YPO the other day on how I've used Twitter. I tell people it's a modern day business tool to build trust. It's to build trust and friendships at scale. There is no better way. You'll end up being the largest self-storage owner. You'll probably end up being the largest cost seg company. You'll probably end up being Mitchell's going to have the largest. Mitchell could have an infinite amount of clients on accounting for what he does. He's so specialized and so smart about what he does that it's really about how big does he want to grow at this point.
And how he made
scale? One statement.
Correct. And how can you scale 1,000 relationships?
Mitchell Baldridge made one recommendation to me that's probably saved me $10 to $20 million over the next 5 to 10 years of my life. And I'm going to brag on you for a second, Mitch. I was talking, it literally went from me arguing with my CPA about a cost seg and depreciation, saying, hey, we need to do this, to me talking to Mitchell and him getting into my PPM on my real estate offerings and saying, Nick, you're building a lot of these relationships with people who have jobs. Go out to your 9 LPs on this deal and ask them all if they're real estate professionals. Like, ask them all how they would use this depreciation. And I went and asked them, and all 9 of them, none of them were real estate professionals. So he's like, okay, Nick, like, let's raise the pref 1 point and let's take some of the bonus depreciation as a sponsor, because they can't use it. They have no use for it. And that one decision, we do that with the same group on some areas. Just one example of a way that if you have the right people on your team and you know how they think and you know how to get them, and Twitter allows that to happen, millions of dollars can hang in the balance.
Especially, I mean, you look at, I talked about Barrett earlier. I'll talk about him again. He's hitting this one drum so loud and so smart. Or you take LIHTC credit, like low income housing credits, or you take kind of strange little esoteric things in real estate, and then you explain very clearly what they are and how they're used and what the benefits are and what the drawbacks are, and you gain trust in people, and then you can go execute these really odd strategies at scale and find the perfect target people who need what you have to sell. And I mean, there's so much value capture in that, because when these are sold by these big companies, there's layers and layers of fees and bullshit and commissions. And it's just like, no, here's who I am. Here's what I have to sell. Here's how it could benefit you if it does. If it doesn't, keep scrolling. Give me a like. But it's a really, really awesome thing for niche service providers, niche businesses, niche real estate professionals, where, I mean, how else would you have the opportunity to go, I'm going to go to, do opportunity zones here, do storage here, do industrial here, do multifamily here, and basically build out your own portfolio through people who are really putting themselves out there and are really, doing the work in public. So to
I think
speak.
the other thing I think about is, like, I know how uncomfortable it can be to start, but I have a deep respect for the people that stick with it, that build that. So when I meet somebody like you, Nick, or you, Mitchell, or our buddies, and you can see that they've put in a lot of work, you kind of you have a respect for, like, them getting over maybe any social fear they had of, like, putting what they know out there. That vulnerability, like, by the time you actually get to know them in person, I often trust them more than I trust people that I've, like, in real life that live in Fort Worth. Not that I don't trust people in Fort Worth, but there's a new level of, like, connection and trust. It's like, man, I get what these guys have gone through to put themselves in this position, and nobody gets to that level being like a faker. You can't fake your way to, it's not just the amount of followers, but to have the level of respect on a social media platform. I mean, I would say, like, with Mitchell, like, you've made tax cool. You've made something that, like, not a lot of people want to think about. You've made it go, look, it is the largest line item in you will pay more money to the government than anybody else on the planet. If that doesn't get your attention alone, now here's 5 years worth of, like, repetitive ways that I'm going to help you save money. And guess what? You have to do nothing but follow me. You don't have to pay me $1. You can just sit here. I'm going to keep giving it to you. If anybody doesn't respect that, and Nick, we can go into all the things that you've done, but I'm using something like tax as a way to go. It's been hard for me to really want to pay attention to tax for a long time. And I would say Mitchell has totally gotten the bull by the horns and made me totally, like, obsessed about it in almost every single way.
Yeah, you go find somebody $100,000 with one tweet thread, and they all of a sudden want to
send you a bottle of bourbon for Christmas.
Yeah.
But then you go to Nick. I mean, we can laugh about the Storage Bros thing, but let's be honest. Nick has created legitimately an army, a category of people that have changed their whole entire lives because they started following Nick on Twitter.
Nick posted a picture a couple months ago that it's just some shitbox self-storage thing out in eastern nowhere. And he goes, this thing could make you $1 million. This could change your life. Like, and it's dead true. And man, I want to talk to you both about something. And I lump Moses in here too. And this idea has been just ringing in my head over and over and over again of like, Nick and Chris and Moses did not work as private equity analysts, did not ever get, bestowed upon them the validation that they could do what they wanted to do. I mean, you all went to good colleges, you all had good jobs, and well, not Nick. Nick never had a good job, but but I mean, this idea has really changed my mind of just like permissionless. Like, you do not have to ask to be what you want to be to go buy $1 billion of industrial or go buy $50 million a year of mini storage. That's the most powerful lesson of Twitter is the people, Keith Wasserman, who have like earned their way to the top of real estate Twitter are, I mean, some people had private equity jobs and some people went to business school, but some people are just misfits. And it's just like the idea that you can just go do something and you don't have to ask anybody has really struck me.
Chris Powers would not have gotten a job if he'd have went to Sam Zell and said, "Hey, hire me out of college."
No way.
He would have told you, Chris, that you are not qualified. You do not have permission to be at my firm.
For sure.
Yeah, I'm going to go to University of Chicago, Booth School of Business, and pluck out the top whoever.
And
just paid.
And this is a loaded statement. Obviously, Sam is a legend, and so much of my inspiration has come from Sam. But it's the point I'm trying to make is Twitter is the Sam Zell. You don't have to go work for Sam Zell anymore to be Sam Zell. You can get on because it's everybody is one piece of information away from changing their entire life. They're one relationship away. Well, the social media and the internet changed the game. It used to, all the information was guarded. You had to work at Goldman Sachs. You had to work for Sam Zell if you wanted to be somebody. Well, now I'm not saying that they still don't have proprietary information that's valuable and that people that work there aren't going to do great. What we're talking about is how do you spread more success to more people? Because not everybody can work at Goldman Sachs. Not everybody can work for Sam Zell. Not everybody can go work for the Big Four accounting. Just get on Twitter.
Dinner tables, right? The dinner tables that real estate families pass on that gene, where real estate families at the dinner table teach their kids how to do real estate. Like,
right.
That's how it's passed on. But you don't need that anymore.
You don't need
have
that.
To have it anymore.
Twitter is the dinner table.
So you go read Moses's blog.
This is the dinner table. This podcast is the dinner table. This is the dinner table, and it's free for anybody that wants to listen. You can troll us. Pokemon Trollboy 69 can come troll us all he wants. But we're going to keep opening up the dinner table to as many people that want to eat with us. I like that. I might actually make a new Twitter handle. That'll be my anonymous Twitter handle name.
Pokemon Troll. Well, it's not anonymous anymore. You just blew it, man.
All right, I'll be 68.
Bleep that out, Johnny.
The only way that this would be more fun is if we were in person sitting around Chris's table, and then we're going to go out for a bourbon after this.
I think we might have caught on to something. Maybe we'll do this one again in a couple months. This is the three of us. This is a good podcast.
I like it. Well, Chris, you're a great host. This is you put together a phenomenal run of shows here.
I appreciate it.
Pulling and everything.
I am so fortunate to be friends with y'all. It's been one of the highlights of the last 5 years. So
people who have interesting things out there to say, or who are willing to go in and share their knowledge, or take really, really complex subjects that they know really, really well and boil them down to succinct, simple things. Just 3 years ago, none of us knew one another. We weren't kind of playing in this world, and here we are all together. And it is not too late to start. It's not too late to go out there and start, sharing what you know and building a presence online. So I would encourage anybody to do that. It's changed my life. It's brought all of us ahead 20 years in our career.
Infinitely.
Sure.
You can learn really fast too if you approach this stuff with an open mind. If you're not stubborn,
you're the best at that, Nick.
Go ahead.
Oh, I don't want to seem dumb online. I don't want to. At the end of the day, I'm a CPA, and there is a tax code, and there is like a reality that you have to be able to spec
there's
against.
There's no business code, right? There's no code that a business owner gets to read to see how to do what he does. So for me, if I think something or I feel something, or I call it like strong opinions loosely held. I'm gonna do the work personally as a person to have really strong opinions. I'm going to surround myself with people in my business and in my life who call me out on my bullshit, and I'm going to listen to them, and I'm going to show them respect, and I'm going to reward them challenging me. So I'm not surrounded by a bunch of yes men. And then on the internet, I can post aggressive, what seem to be engagement baity, hot takes. But really what it does is it leads to a lot of really smart people piling on and giving their opinion. I take some of them, I throw them out, I look at others, I kind of frame the way I'm thinking, and it does help me hone my thought process on really important things, whether I'm making decisions around business, whether or not I'm thinking about the real estate markets the right way, management, hiring, delegation, things that I'm really into. I can challenge the Twitter and I can challenge my friends. And if I have an open mind and I'm willing to change my mind and find the truth instead of ego of, hey, Nick's right and I don't give a crap about what anybody thinks, I'm going to be the one who's right. You can learn a lot really, really fast.
Yeah, you've been the king of that. There's no doubt about that.
I make some people mad on the internet too.
I think your strategy's always been brilliant. I've always told you that.
I appreciate the support.
Well, I'd support you. I'm here for you. I've always been here for you. Even when Pokemon Troll Boy 69 is coming with his torches and wants to come get you.
Even back to Dan as the unsung hero.
Dan is the unsung hero. This we might title this episode Dan the unsung hero.
I'm high speed. I'm like a hummingbird on caffeine, and Dan is the one who is the person steering the ship and pushing the brake and making sure all this stuff gets done.
All right, boys, let's go make it happen out there,
Chris.
Yeah, thank you for having me. As we sat back years ago and were envisioning where Fort was going to go, we realized we needed to bring in a global workforce, a remote workforce that could work with us. And a few of the reasons why were obviously cost, which I think is the first thing that comes to everybody's mind. But then when we talk about shifts, a 24-hour shift, and maybe you can go a little further there, and some of the other benefits that we've realized as we've gone on. And now we sit here today in 2022. At the time we first had this was maybe 10 employees. Now we're at 46. Mm-hmm. And as you think about the next chapter and how we're scaling, it's almost inconceivable that we would do it without Relay Human Cloud. So can you just talk a little bit more to how the shifts work at Fort and the productivity and some of the other benefits that we've learned about working with a global workforce?
It's actually been pretty transformational from how we think about how we're going to not only get stuff done today, but how we're going to get stuff done in the future as we grow. And so when you start going down that path of thinking about you're going to start working with people on the other side of the world, right? There's a lot of questions that come up. How are we going to do it? How are we going to train them? How are we going to manage them? Who's managing them? All those things come up. What we found with Relay Human Cloud was that all those thoughts had already been taken care of, and that we could focus on what type of talent is there that can join our team. Does it fit our need? And once we saw that all that thought and energy had already been put into the operational part of managing and running a team, and the thing that we focus on here locally, then it was just a matter of finding the talent. And what I think that Relay Human Cloud has done really well is find a lot of great talent. And, these are people that are highly educated, that can provide a ton of value to a company like ours that otherwise we can't find here. And obviously it's at a high or a extreme cost savings compared to what we could find here. So what we started looking for was how could we supplement what we currently do with the team overseas. And it started off for us from an accounting perspective. We have a lot of these things that are repetitive, task-driven, that just never end. And we knew that our team was taking on a lot of work during the day, which was limiting our ability to take on new properties. And so we have a choice. We can hire another accountant or another staff accountant, or promote somebody and bring that person on. But we're really just trying to solve, at first, a repetitive task. So when we reached out to Relay Human Cloud, we discovered that not only could we solve that problem, we could get a very qualified person that could not only do that, help support on a lot of other things. And so very quickly it turned into, we're trying to solve some repetitive tasks, to bringing on more and more team members that were actually helping us grow our accounting department without having to bring on a lot of people here. And so that just continued to grow. So since then, we've brought on additional assistants, but it started with accounting. The benefit of having a team working globally is that you get the benefit of around the clock, and it never ends. And so because we have a team here working on things, obviously the time runs out during the day, but there's things that they're gonna come into work tomorrow, and they're gonna have to start doing that again. One of those things is, and a good example is, cash reconciliations of every bank account. At Fort Capital, we have 50 bank accounts, and there's cash reconciliations that have to happen every day. Well, that was something that locally a team had to come into work and start working on every day. Well, that just means there's other things they can't start working on. What happened immediately with our team at Relay Human Cloud was that overnight they were processing all those. They were doing all that accounting work on the back end, so that when our team showed up in the morning, they could start on more important tasks that were happening locally, directly related to the property. And that allowed us to create efficiencies. And so that's just one benefit. We can go through an entire list of things that we have discovered that overnight can be done to help increase the efficiency of the accounting team. That extends beyond the accounting team. It also extends to the property management team, processing invoices. So Fort Capital, we have millions of square feet of industrial space across the country. And with that, you have a lot of invoicing that's happening at all times. You could name a million things, whether it's paying bills, contractors, tenants, whatever it is. There's a million invoices and that can all be processed in India overnight, so that when our team comes in, they're not spending their day processing invoices, which allows us to get to more proactive accounting measures, so that we're using our accounting team to actually push the company forward, not keep up with what's coming at us, right? And so we found a ton of efficiencies by having the 24-hour workday.
So following that up, it was also important to us, because that could have been done anywhere, but we wanted it happening under one roof with people that we knew, that we worked with daily, that were part of our team. And so as you think about these people that are halfway across the globe, it still doesn't seem like it seems like they're in the next room over.
Right. And that's a good point. And I think what's important to understand there is that this group of individuals that are working in India are working directly for our team. They are a part of our team. They're in our systems. They communicate with our team every day. They are not just an extension of our team, they are a part of our team. And so it is much, much different than if you go hire a third-party service out there in the world that you're asking to process invoices, who you're having to send critical or important data to that is, or might be sensitive, right? Information. We actually have all that internal, and this team is a part of that internal team. And so it's a much different way to look at outsourcing than if you're just outsourcing it, even here locally in America. There's a risk there that you're sending your data to somewhere else. This is all happening internally.